Drawdown is one of the most important yet often misunderstood concepts in the world of trading, especially in the Forex market. It's a crucial term every trader must grasp and master to achieve long-term success. But what exactly is drawdown, and why is it so vital? In simple terms, drawdown represents the maximum reduction in an account's capital over a specific period. It's the difference between the peak value and the lowest value of your account balance before it recovers. For instance, if you start with $10,000 and your account drops to $8,000 before bouncing back, your drawdown is $2,000 or 20% of your initial capital. Drawdown is a key measure of the risk you take in your trades. It not only shows how much you're losing in monetary terms, but also how these losses can affect your ability to make decisions. A significant loss can induce fear, anxiety, or even the temptation to abandon your trading strategy, often leading to costly mistakes. There are different types of drawdown. One is absolute drawdown, which measures the difference between your initial capital and the lowest balance in your account. Another is relative drawdown, calculated as a percentage of the account's peak value before the decline. Both are critical for evaluating the performance and sustainability of your trading strategy. Why is it essential to monitor drawdown? Because it helps you determine whether your trading strategy aligns with your goals and risk tolerance. A strategy that generates profits but frequently incurs deep drawdowns may not be sustainable in the long run, especially if the losses surpass your ability to recover. Reducing drawdown is a key objective for any trader. Achieving this requires implementing sound risk management practices. This includes limiting the percentage of your capital at risk in each trade, using stop-loss orders to protect your positions, and diversifying your portfolio instead of relying on a single strategy or currency pair. Another crucial factor is emotional discipline. Drawdown can negatively impact your confidence, leading to impulsive decisions such as over-leveraging or abandoning a strategy that is effective in the long term. It's vital to stay calm and adhere to your trading plan, even during challenging periods. Drawdown is also linked to the concept of recovery, often referred to as the recovery factor. The larger your drawdown, the harder it becomes to recover your capital. For example, if you lose 50% of your account, you'll need a 100% gain just to break even. This highlights the importance of limiting losses before they become unmanageable. Summary: drawdown is more than just a simple metric. It's a powerful tool for assessing risk, evaluating the effectiveness of your strategies, and maintaining the sustainability of your trading account. Understanding it and learning how to manage it is one of the most valuable skills a trader can develop.